Welcome to CoreLogic's housing market update for February 2025. Nationally, dwelling values were steady in January, continuing a softer trend of housing conditions that's been evident through most of last year and now into 2025. The annual growth trend has more than halved since moving through a cyclical peak in February last year, slowing to just 4.3% in January. Drilling down, the national headline result was weighed down by the capital cities, where values fell by 0.2%. The combined regional markets were stronger, with values rising to new record highs, with a 0.4% lift in values over the month. Across the capitals, 3 of the 8 cities recorded a decline over the month, led by Melbourne with a 0.6% fall, followed by the ACT and Sydney. The mid-sized capitals are still seeing growth, but conditions have eased here as well. Brisbane and Perth have recorded a clear and steady loss of momentum, especially in the detached housing sector, where value growth has eased more noticeably. Adelaide's shown a more resilient trend, although the pace of gains is slowing. Adelaide's led the growth tables over the past few months, taking over Perth's top position. Regional markets seem to be benefiting from a second wind of internal migration that's supporting demand. However, the trend is shifting from the heights of the pandemic, where commutable lifestyle markets were standing out with the highest rates of capital gain. The strongest regional markets are now centred in regional Queensland, with Townsville up 26%, Central Queensland up 20%, and the Mackay region up a little bit less than 20%, leading the annual growth tables. In other signs of a slowdown, the national volume of home sales also appears to have peaked. Annual sales moved through a cyclical high point at just under 535,000 sales in the year to October, and they've since eased back to 526,000 over the year to January. Rental growth bounced slightly higher in January, up 0.4% over the month, following a subdued second half of 2024, where the national rental index held virtually flat. Every capital city recorded a subtle rise in rents over the month. However, the trend is clearly pointing to an ongoing easing in rental price growth. On an annual basis, Australian rents were up 4.4%, which is still more than double the pre-COVID decade average of 2% annual growth. However, with rental growth slowing more visibly through the second half of last year, the annual change in rents is likely to fall below average levels in the first half of 2025. The 6-month trend in rental growth has turned negative across the 2 largest markets, Sydney and Melbourne, with rents down 0.4% and 0.6% respectively, with larger falls across the unit sector. The remaining state capitals have all recorded a clear slowdown in rental growth as net overseas migration and larger households help to ease rental demand. Regional rental conditions have been stronger relative to the capitals, with the combined regionals rental index up 1.6% over the past 3 months, compared with a 0.3% rise in rent across the capital cities. Now let's take a tour across the capital city housing markets. Sydney's housing market moved through a 4th straight month of declining values, with the market down 0.4% in January to be 1.7% below the record high set in September last year. House values have fallen more substantially than units, down 1.9% and 1.2% respectively from their peak levels. The weaker conditions coincide with higher advertised stock levels. This is where listings are tracking 5.6% higher than a year ago and 6.9% above the previous 5-year average. With higher stock levels, homes are taking longer to sell, with a median of 43 days on market compared with 38 days to sell a year ago. Melbourne home values recorded a 10th straight month of decline in January, down 0.6% to be 3.3% lower over the past 12 months. Since peaking in March of 2022, Melbourne home values have now fallen by a cumulative 6.9%, or approximately $58,000 in dollar terms. The 2% decline in values over the past 3 months is the largest rolling quarterly fall since the 3 months ending January of 2023. Advertised supply levels remain elevated across Melbourne, with listings tracking 6% above the previous 5-year average and roughly on par with levels recorded at the same time last year. With high stock levels, the median number of days it takes to sell a property is lifted further to 44 days compared with a median of 39 days a year ago. Home values continue to trend higher across Brisbane, but the pace of gains has noticeably cooled. January's 0.3% rise was the smallest since February of 2023, as higher stock levels, lower population growth, and affordability constraints support a slowdown in conditions. The softer conditions are most evident across the higher price points, with upper quartile dwelling values flat in January, while lower quartile values rose by 0.6%. Slowing housing market conditions can also be seen in vendor metrics, where homes are selling in a median of 27 days, up from just 18 days at the same time last year. The pace of growth in Adelaide home values has been more resilient than most markets, although the rate of growth is easing, with a 0.7% rise in values in January and up 1.8% over the past 3 months. Adelaide has overtaken Perth to record the highest rate of growth across the capital cities. Strong conditions are supported by ongoing low levels of supply, where listing numbers remain 4.3% lower than a year ago and 41% below the previous 5-year average. With such low stock levels, homes are continuing to sell rapidly, with a median of 29 days on market, lower than the 31-day median at the same time last year. After a period of spectacular but unsustainable growth in home values, Perth's property boom has eased sharply, with a rise of just 0.4% in January. Over the past 3 months, values are up 1%, well down on the 7.1% gain recorded over the June quarter last year. The slowdown in value growth has been accompanied by a rise in advertised stock levels, which are now tracking 6.2% higher than a year ago. Despite the easing conditions, advertised supply levels remain tight, and homes are selling in a median of just 16 days, the fastest rate of sale of any capital city, but up from a median of 10 days at the same time last year. Hobart home values remained flat in January, but they were 0.8% lower over the past 3 months to be down 0.9% compared with a year ago. Hobart's housing market has been moving through a period of weakness, with values now 12.5%, or approximately $94,000 lower relative to the record highs set back in March of 2022. The silver lining of lower home values, of course, is that affordability has shown a substantial improvement across Hobart, with the median dwelling value the second lowest of any capital city after Darwin. Although conditions remain soft, advertised supply levels have reduced by 14% relative to a year ago due to a slowdown in the flow of new listings coming to market. Home values across Darwin were 0.6% higher in January, taking the market 1.7% higher over the rolling quarter to be 0.9% higher over the past 12 months. The 3-month gain was the second highest of any capital city, after Adelaide at 1.8%. Houses are delivering the stronger capital gains, with values up 2% over the past 3 months, while unit values have risen by a smaller 1.2%. Darwin remains, by far, the most affordable capital city housing market, with a median value of almost $503,000. Stock levels are extremely low, tracking almost 40% lower than at the same time last year. ACT home values have fallen over 6 of the past 7 months, down a further 0.5% in January. The unit sector has been the main drag on housing growth rates, with values down 2.7% over the past 12 months, compared with a 0.2% rise in house values over the same period. The relatively soft conditions can be at least partly attributed to higher advertised supply levels, where listings were tracking 8.5% higher than a year ago and 9% above the previous 5-year average. With stock levels remaining high, homes are selling in a median of 48 days, slightly above the decade average of 46 days. With the prospects of a rate cut as early as February, the housing outlook is starting to look a little more positive, but we aren't expecting any material rise in home values until interest rates return closer to the pre-pandemic average and affordability improves further. The commencement of the interest rate easing cycle will be welcome news for borrowers and prospective buyers alike. Following a lower than expected core inflation outcome for the December quarter, there's still a good chance we'll see the first rate cut in February. Additionally, most forecasts are factoring in 3 to 4 25 basis point cuts from the RBA this year, implying that by the year's end, the cash rate would be between 3.35% and 3.6%, but that's still well above the pre-COVID decade average of 2.55%. Nonetheless, lower mortgage rates should act as a net positive for housing demand, increasing borrowing capacity and providing some repayment relief for borrowers. Along with lower cost of living pressures, a lift in sentiment and income growth, housing demand should see some support. Low levels of newly built housing supply should also deliver some support to housing values. The good news for housing supply is that dwelling approvals are once again trending higher, although this is mostly for houses and is more evident in Western Australia and South Australia, and to a lesser extent in Queensland and Victoria. However, high labour and material costs, as well as ongoing competition for key inputs with the public infrastructure sector, are likely to keep the flow of new housing supply at insufficient levels for some time yet. Some regions have seen a substantial affordability improvement since peaking back in 2022. Hobart recorded the most significant correction, with dwelling values down 12.5% since moving through record highs in March 22. In dollar terms, this means the median value is now approximately $94,000 lower. The ACT has recorded the second largest decline amongst the capitals, down 7.1%, or roughly $65,000 down from peak levels. Melbourne values are 6.9% below peak levels, the equivalent to a drop of around $58,000 in the median value. Other markets are likely to struggle with affordability pressures even as interest rates drop. Over the past year, home values in Perth have surged by 17.1%, or $118,000, resulting in a 78.2% increase over the past 5 years. Adelaide has seen values rise by 12.7% in the last 12 months and 73.7% over 5 years. Brisbane's up 10.4% over the past year and a 70% rise in 5 years. Although Sydney's recorded a relatively mild 1.7% rise in values in the past 12 months, in dollar terms, that still equates to about a $20,000 increase. A rise in demand for housing from lower interest rates will be partially offset by slower population growth. After peaking in the first quarter of 2023, the net overseas migration rate is expected to reduce further as overseas arrivals continue to moderate, alongside a pickup in departures as the surge in temporary migrant visas expires. Less migration is likely to flow through to further easing in rental conditions and, over the medium term, reduced demand for home purchasing. Tighter credit policies could also be a wildcard, potentially slowing housing markets in 2025. APRA has stated the risk of financial shocks has not abated, and the RBA has warned previously that high household debt levels, especially housing debt, are a key vulnerability. Any material rise in household debt ratios could be a trigger for tighter credit policies, which would likely put a dampener on housing demand, similar to earlier periods of macroprudential policies. Overall, lower mortgage rates and a subsequent lift in borrowing capacity, as well as an undersupply of newly built housing, could be setting the foundations for a relatively shallow housing downturn. But the easing cycle for interest rates is likely to be a gradual one, and we also have the ongoing headwinds of affordability constraints, normalizing population growth, and generally soft economic conditions to contend with. All things considered, the likelihood of a significant growth cycle over the coming year remains low. If you'd like to stay up to date with all the ebbs and flows in the housing trends, make sure you're following the news and research pages at the CoreLogic website and tune into our regular updates at all the usual social media channels.